Hello everybody and welcome to the Like Totas channel. Happy Wednesday to all of you, dear viewers. In today's video is going to be a long-term compounder that has a phenomenal track record of creating shareholder value for shareholders like us. And spoiler alert, it's LVMH. And this is a company that I think you can basically buy it and follow a sit and forget approach for the next 10, 15, 20 years, if you ask me. But in this video, I'm going to break down exactly why I believe this company deserves a place in your portfolio. And if you guys are following the channel for a while, then you definitely know that LVMH is a company that currently can be found in our portfolio. And I haven't sold a single share, even though at one point the stock had a very good run in a short period of time, and I'm going to tell you why. Okay, so hopefully we'll find this a lot of value, valuable. And if that is the case, make sure that you smash the like button because it really helps the channel to grow. Okay, everyone. So LVMH, they reported earnings about 3 to 4 days ago. Before recording this video, I was actually going through their earnings reports and conference call. And as always, I put everything together in a document and I will walk you through it right now. As you can see right here, we have a ton of data to go through because this is the report that they released right here. Right? So the quarterly report, which breaks down the revenues by segments and all of that. So I always, for those of you who are new to the channel, yes, because I like to understand the companies that I invest in very well, that means we always need to do some due diligence. Now, many of you watching this are probably busy professionals. Again, this channel is for you because I was once a busy professional myself and I didn't have a lot of time to look at my investments on a daily basis. And we certainly don't need to do that if you follow the Like Totas framework, which is all about finding high quality companies when they are trading with a big margin of safety. And then all we have to do is check in with them periodically, and that means on a quarterly basis when they report earnings, because we want to make sure that the thesis is intact. Okay, so all you need is about 1 hour per week, and that is what we do here in order to achieve above average returns over time, because our goal over the very long term is going to be to to at least double our money every 3 to 4 years. That's what we want. And we have been doing that so far. So anyway, I digressed. So this is the report that they released. You can also see that I was listening right here to the conference call. Let me minimize this because this is the time where this is the CFO, by the way. So I was listening and making a few notes along the way because I want to hear what they say about the quarter. So for example, LVMH, if you know the business, right? Otherwise you wouldn't be investing in it, but they are a huge conglomerate. They are the largest luxury empire in the world. They have several brands and they operate all throughout the world. So now with the conflict in the Middle East and the headwind of tariffs, you have to understand what the business looks like, right? Are they facing any headwinds? And now with the breakout of the war in the Middle East, they actually mention that, and we will talk about that as well as we delve deeper into the report. But that caused some short-term temporary setbacks. But this is nothing structural. What we want to do as long-term investors in a great company is we want to separate what is structural from what is temporary. And temporary can take no more than 3 years. At least that's my preference. If it's structural, then the thesis is broken and I'm either out if I've already invested in the company, or it's an easy pass for me if I was just considering an investment in it. Okay? And then you can see that right here, they also released the presentation. So the investors presentation that they walked analysts through at the time that during the conference call. And I put everything in that document that I was discussing, and that is right here. Okay, so let's discuss everything you need to know. LVMH quarter one 2026 sales overview. And by the way, if you don't know LVMH, I'm just going to show you this image right here because I mean they say that an image. I don't know exactly how the saying goes, but I think it's like a picture tells you is worth 1,000 words, right? Something like that. And just look at this empire, everyone. When I when I when I told you that they are the largest luxury empire in the world, I mean this is exactly what I mean. You can see all the brands that they house, and they span several business segments as well, as you can see, from fashion and leather goods, which is by far the major contributor to revenue. This segment in and of itself represents about 50% of revenue, which is incredible. Then you have selective retailing. No, that is not right here. Okay, selective retailing, which has been on an absolute tear because Sephora is on a tear. Let's just leave it at that. And then you see the other category, which includes wines and spirits, other activities, watches and jewelry, perfumes and cosmetics, which include brands like Christian Dior, and so on and forth. And not to mention all the private equity deals that they have as well in the portfolio, which is in the minority stakes, for example, Hermes that they have. So this is a company, everyone, that is not going to go anywhere but up over the very long term. If you ask me, as always, I put my money where my mouth is. And if you follow this channel for a while, you know that this is a company that I am invested in. Right, so let's go now that I set the context. And by the way, you can even see right here that I put together a report on the company not that long ago, because I always like to understand the companies that I invest in very, very well. And LVMH is not an exception to that rule at all. You can see right here that I created a full deep dive on the company that covered all these different topics. Do I understand the business model? Is management capable? Do I think they have a competitive advantage? Do I think they are active in a competitive, in an attractive end market? And then this all culminates into a final question: should we invest in the company? And this report is made available to subscribers of Tortoise Labs, which is our community that we have on school. If you want to know more information about that, just let me know, and I will give you more information. But look at that, the biggest luxury business empire right here, housing all of these brands. And then I talk about the company is active in 5 main segments. As I was discussing, the fashion and leather goods represents almost 50% of revenues, while selective retailing comes second at 18%. These brands, this is just incredible. A lot of resource, a lot of data right here. I even went to Glassdoor and checked the overall score of the CEO Bernard Arnault, and he gets an overall score of 79, which is staggering. And why is this relevant to me? Because I like to invest with people that are people whose employees like. Let's put it that way. If you work at a, so before investing in a company, I like to understand what the employees are saying about the management teams and about the CEO. And the fact that the overall score is very high is a very good thing. You can see that this approval rate is in the top 5% of all CEOs of similar sized companies on Comparably. And you can also see that not only do they approve of the CEO, but the employees' overall satisfaction level with the company is quite high at 84%. This, everyone, is very, very important. I wouldn't be telling you to own this stock for the next 10 years if I didn't believe in the company. Once again, I put my money where my mouth is. Okay, let's go back right here to our report, and then we will discuss the numbers at length. Where is this? Why can I not find the report? Bear with me 1 second. Right. Key financial highlights. Organic sales growth 1% in Q1 2026. Analysts expected 1.5% growth, which means that they missed these estimates. They missed this estimate slightly. Let me just take a sip here. Total revenue came out to 19.1 billion, again slightly below expectations. Impact of Middle East conflict, 1% negative impact on organic growth. And just to explain things a bit better, they always report organic growth numbers versus reported. What does that mean? It means that the organic, when they say reported figures, that already accounts for the currency, for the effects on currency exchange rates, and also it accounts for acquisitions and divestitures. Sorry, I'm Portuguese. So that's it. So they report that, but they also report the organic. And I always pay more attention to the organic figures because that tells you, because it really shows you the underlying operational performance of the company. And you can see that how the balanced geographic revenue mix looks like. You can see this is in percentage of total revenue. What you can see right off the bat is that the United States, together with Asia, represents over 50% of the company's revenues. So, what does that mean? It means that since the tariff started, of course, the company got impacted because most of their revenues come from these regions. And this is not something unique to LVMH. Other luxury companies, and that includes even car names like Ferrari, for example, a lot of their revenues come from China. And because the Chinese consumer is still going through that property slump, they pull back on spending. And in addition to that, there is this tariff war happening still between the United States and in China. And until there is some resolution, in fact, I think both presidents are meeting in the not too distant future, which can be very well if they shake hands and an agreement is made. But until then, we will continue to see more volatility. And now we have the war in Middle East, another setback. Anyway, so this is what the geographic split looks like. Now let's talk about regional performance. They mentioned that the United States had a strong start to the year. Europe and Japan showed resilient local demand, offset lower tourist spending. Asia, excluding Japan, showed strong growth. I like to see that. This is something that we saw in the previous quarter. And the reason this is important, once again, is because Asia is by far the most important market. Asia, excluding Japan, China. And you can see that this confirms trends from late 2025. Analysts were expecting a strong rebound for the entire luxury sector the moment the moment Chinese spending perked up. And we seem to we are having some confirmation right here, which bodes well for the company. But Middle East initially positive, then impacted by ongoing conflict. And so this is what the Q1 2026 organic revenue change by region looks like. You can see that Europe was down. Let me zoom in on this. Europe was down 3%. United States was up 3%. Japan was down 3%. And then Asia, excluding Japan, was up 7%. So the total LVMH organic revenue came out to just 1%. All right, I hope it makes sense. So what are some of the market trends and expectations? Future growth analysts expect significant growth in upcoming quarters. Brands must adapt to regain customer loyalty post-boom. What does that mean? If you know, of course, all of these companies benefited greatly in the lead up to COVID, right? In fact, during COVID, because that's when people were at home, they found themselves with a lot of money in their hands and a lot of time. And so these companies benefited sharply. And if I show you this right here, going right here to financials, you can see how the company, do I have uh, do I have their revenue? Yeah, you can see that the revenues in right here in 2022, in fact, they reached the peak right here in 23 and have since come down against the backdrop of all the setbacks we've been highlighting. But still, so we are seeing some post-COVID normalization as well. So that is part of the reason why the company has been underperforming relative to its recent performance. All right, and and so let me continue. And that's why I'm in here. So brands must adapt to remain customer loyalty post boom. In addition, what happened, guys, after with inflation and all of that, these companies started to raise pricing, raise prices. And so, because the customer, as you all know, in the United States, for example, but all over the world as well, has been very cost conscious, then they start cutting back on things that are discretionary items. And LVMH sells luxury products, even though they show quite resilience during recessionary periods. They will feel the heat, and that is what we are seeing right now as well. So they have to regain customer loyalty. And that's why they have been releasing new products and innovating as well. And the response has been positive, according to what they mentioned during the conference call. Luxury market recovery, slow recovery after slump due to reduced Chinese consumer demand. Okay, so yes, the consumer in Asia, in China, has been slowly starting to spend a bit more, but it's not at the best levels, and we know that. Segment performance, fashion and leather goods was down 2% organic basis. Wine and spirits saw 5% organic growth. Watches and jewelry 7% organic increase. Selective retailing 4% organic growth. Sephora gaining market share. The fashion and leather goods, everyone, is by far the most important category, and they were actually down 2% on an organic basis. I pulled this out from took the screenshot from the report, and you can see that right here. On a reported basis, which accounts again for the effects of the currency exchange rates, you can see how the fashion and leather goods was actually down 9% on a reported basis. But then on an organic basis, they were down 2%. So the total, on a constant consolidation scope in currency basis for the group, the impact of changes in scope was nil. The impact of exchange rate fluctuations was -7%. Okay, -7%, which is staggering. But so this is what you can see. In Sephora, gaining market share is very good. I think selective retailing accounts for about 14% of the overall revenues, as I already discussed when I showed you that the school community and gaining traction. That is good to see. But we need to see a recovery in the most important categories for margins to go back up. What do I mean by that? We are seeing some margin pressure, and it makes sense, right? But if I show you this right here on the income statement, on the trailing 12-month basis, you can see that gross margin is it took a bit of a hit. Nothing to write home about. They are still very important, very, very healthy now, but now they are flat right here. Look, right here into quarter two 2024, they were at 68.53%. In quarter two 2025, they were at 66%. So, okay, and then the operating margin, this is where the biggest hit was, but they are slowly starting to move that up again. And in terms of profit margin, we are seeing more of the same thing. So we are seeing some impacts right here across margins, but that is understandable given all the things that I already highlighted. namely the consumer pulling back on spending, which slowed down revenues, but also the fact that the company needs to spend strategically in order to remain competitive. And if you go right here, the SG&A, you can see that they continue to spend in. So these are all operating costs that have been going up, but in fact they have stabilized since 2025, but they haven't come down stronger to accelerate profitability, and that shouldn't happen because otherwise they would be sacrificing their marketing, their leading market position. Right. So mixed global performance. Sales declined 6%. Yeah. Sales declined 6%, reported decline due to unfavorable exchange rates. Mixed global performance, 3% drop in Europe and Japan, 3% increase in the US, 7% growth in Asia, including Japan. We see ongoing challenges, potential sales and margin pressures from Middle East conflict. Potential sales and margin pressures, as I was alluding to. Strategic considerations, opportunity and weakness, potential for M&A to expand brand portfolio. What do I mean by that? LVMH is a serial acquirer, everyone. And so they do a lot of acquisitions, as I showed you the portfolio. So this market backdrop can actually become a big positive for the company because they are a family-owned businesses that focuses on the long term, and they can take this opportunity to start building, either acquiring companies, right, or start building stakes in publicly traded companies at very attractive valuations. And I think this is very good. So let me show you what I mean. If we go to the cash flow statements, you can see, do I have that? Let me see the purchase of investments. Exactly. So do we see that? You can see that they have done some acquisitions as recently as well. That is good. I expect that to happen. CapEx is also was going up until 2023. Now it's slowly coming back down because they are more cost conscious. So they are aware that the fact that the business is going through a slump, and they want to be more careful about where they spend money. It makes sense. But yeah, so payments for business acquisitions, to acquire other businesses, you can see this right here. So yeah, maybe they will take this opportunity to actually do more acquisitions. Look at the operating cash flows of the company. Very, very healthy right here. Okay, this is incredible. This is a company that is very, very profitable, and you can see that they generate about 14 billion in free cash flow. Look how free cash flow is actually much higher relative to net income. All right. This is because they have high quality earnings. They convert most of the earnings into cash flows. And I love that. And free cash flows are what we will be using. We will be using free cash flow to put a value on a company as well. Okay. But we will discuss that later on. So, long-term growth strategy, leverage international logistics for brand development. Conclusion, overall resilience. LVMH demonstrates strength despite macro pressures. Future prospects focus on strategic adaptations in market recovery. Okay, hope it makes sense, everybody. Now let's talk about valuation. And by the way, what else did I want to show you? If we go right here to the ratios, you can see that they really are very good. Even against all of these backdrops, you can still see that Royce, after a decline, somewhat of a decline, as you can see right here. Now it's actually improving ever slightly. It's going to be important for the company to actually move this back up over time, and I do expect that to happen again because a lot of what's happening is not structural; it's market related. And if we go right here to the statistics tab on stock analysis, you can see that they are in a very good financial position. The debt to free cash flow is under our preferred 3, which means they can pay all of the debt within less than 3 years of free cash flows. The interest coverage ratios are at 15.35, so they generate enough operating income to cover all the interest payments on the debt, which is very good. And yeah, in addition to that, look, you see, so the WACC is at 8.23%, while the return on invested capital is at 12.88%. This thing needs to go up. It needs to go up because right now the economic spread, if you do 12.88, right? If we do 12.88 minus 8.23, this means they are only creating about 4.65. This is the economic spread. I want to see more value, more value creation, and that will happen once Royce moves back up. Right. The only thing that I don't really like, I mean, it's not great, is the fact that total debt is quite high, as you can see right here, even though they can pay about half of that debt immediately with their cash and cash equivalents if they wanted to. But because they generate a lot of free cash flow, it doesn't really bother me that much. As we already saw, the debt is well covered by free cash flow. So no problem at all. Okay, everyone. So let's discuss valuations. And before I do that, I also want to see. I want to show you what analysts at FinChat are projecting for. In fact, analysts at Fiscal AI, former FinChat, are projecting over time. They say so. The earnings per share long-term growth estimate sit at around 9.7%. I personally use 10%. I think the company can deliver 10% over time, but yeah, it's good to know that they are doing that. You look at the diluted earnings per share 10-year average, about 11.9%. The 5-year average is 18.6%. But this already, again, includes COVID and what happened afterwards. And then you saw the diluted earnings per share three-year compounded annual growth rate. And this is minus 8% because of everything we just highlighted. Okay, so this is important. All right, everyone. So to calculate the real value, the intrinsic value of this company with a margin of safety, we will do Phil Town's 3 valuation methods. And I'm going to walk you through them because I already calculated this because I want to keep this video short but punchy. Current earnings per share. And by the way, if you want more information on how each of these valuation methods is performed, go back to my previous videos because I do discuss this at length, each and every single one of them. Okay, but margin of safety, in simple terms, is better suitable for companies that grow for companies that are growing at very high rates of return, and by that I mean at least 15%. Because if that is not the case, what you will have is a most price that is very, very low. And that is what happens with LVMH. So you start with the current earnings per share, and then you want to compare what analysts are projecting over time, and we already know that is just about 10%, against versus what the company has delivered, right, in earnings per share over the last 5 and 10 years. So which is about 8%. But you can see how book value, which gives you a better indication of the real value that is created for shareholders, you can see that book value has actually compounded at 11% over the last 10 and 5 years. So we can do 11% right here. So the conservative number is the lowest of both, and that is 10%. The default PE, I looked at the historical PE, so the average for the last 10 years, and that is 27.90. I use 23 right here. In fact, I can use 20. You can go higher if you want to. I use 20. I chose the conservative number. But again, bear in mind that the net income is not the accurate measure for this company because free cash flows are higher. They do acquisitions, and acquisitions create a lot of amortization costs that will impair net income. So take that into account. But and then what I did is we estimate the future earnings per share. So we grow the current earnings per share at our projected 10% over the next 10 years. That gives us a future earnings per share of 56.67. And then you multiply that by the projected PE of 20, and you get the future earnings per share, and then you get 1,133. So what this means is that if the company goes on to compound its earnings per shares by that much, and we assign that PE, in 10 years, this will be the value of the company. But this needs to be discounted back to the present, because remember, these are future earnings. We have to discount that back to the present to account for inflation, to account for all of those things, right? That is the real value of a company is based on the future cash flows discounted at an appropriate discount rate. And because we always want 15% on our money, over time, you just divide that by 4. That gives you this intrinsic value. And we never, ever pay intrinsic value. So when you divide that by 2, because we want a 50% margin of safety, you get to a margin of safety price of 141, which is very low relative to the company's current 474 share price. And that is not realistic, precisely because the MOS method is better used with companies that are growing very fast. Think about a Netflix or even an Amazon or even a Google or Microsoft, all of which are growing at least at 15% per year. In fact, analysts are definitely more optimistic, but I never go at beyond 15%. Right, so payback time. This tells you how long it takes you to get the money out of the business from current free cash flows if we bought the entire company at its current price. The way to do this, everyone, we just do the free cash flow per share, or you do the free cash flows in year 0, and free cash flows stand at about 14 billion. And then we're going to grow this at 10% over 8 years. And then we just add up all the free cash flows to get this cumulative free cash flow figure. And we only need to divide that by the number of outstanding shares of the company. And we get the free cash flow 8-year payback time price of 362. That is a lot more realistic, if you ask me. Okay, what does that mean? Why is 8 years? Because the average payback time for a company in the S&P 500 is about 16 times. We want a margin of safety built in, and we want to get that in half the time. In other words, in 8 years. And so if the company does manage to grow free cash flows if the company does go on to grow free cash flows at least by 10% per year over 10 years, you will recoup all of your investment in 8 years if you paid this price. The stock is currently trading higher than that. And look how the model works for the earnings. So if you do if you do earnings instead of free cash flows, look at the difference. The reason is because free cash flows are higher than net income, okay? But free cash flows is the number that is most important. And now my preferred method, because it's the one that does not include any growth assumptions, and so you can argue that it's the most conservative, is the 10 cap rate. You start with operating cash flows, you subtract maintenance capex only, the money that the company spends to run its current operations, right? The company that they spend on replacing equipment, property, and so forth. And so, right, to maintain its current operations, we don't want to strip out the growth capex. And then we add the tax provision that you can find on the income statement. And when you do the operating cash flows minus the maintenance capex plus the tax provision, you get the total owner earnings of the company. When you divide that by the number of outstanding shares, this is what you have. And then you simply multiply this by 10, and that gives you owner earnings per share of 426 dollars a share. What does that mean, everybody? Is right here. I share a lot of value in these videos that I only typically, and I only share in these documents with clients, but I want you guys to learn as well. So the reasoning behind this is very simple. In real estate, investors often accept a 5% cap rate, meaning the property yields 5% of its purchase price each year before growth. Philtown uses a 10% cap rate instead because you want a built-in margin of safety. A 10% cap rate means the business generates a 10% pre-tax cash yield. In other words, if we buy the company at this level, so if we pay at least $426 a share, all we have to do is wait for 10 years to get our money back, even if the company does not grow the business. They just grow. The business stays, simply generates the returns that it's generating today. And if that happens, then we will recoup all of our investment in 10 years. Talk about a big margin of safety. This is what attracts me, everyone. And the price that I pay, so what can we see? What we can see right here is that we have the margin of safety price that is not suitable. So we will leave that out. But you can see how the 10 cap rate is not that far off relative to the payback time. But this method is the one that I would is the one that I would prefer. So if LVMH ever came back down to this level, which happened in the past, then I would be glad to pay this much, because remember, this has a 50% margin of safety built in. So according to this method, the intrinsic value of the company is double that, right? So about 852. And according to the payback time price, the real value of the company is, once again, double the what you see right here. So 362 times 2, that gives you 724. That means at the current price, we have already an attractive margin of safety built in. And that is why I decided to buy LVMH shares not that long ago, because the fundamentals haven't changed that much. My average price is actually lower. So I started buying LVMH around $460 a share. It's a bit lower, but this thing, if this continues to come down, I would have no problem adding more to my position. Okay. So here is the thesis. What you have, ladies and gentlemen, is a company that, in my opinion, ticks all the boxes in terms of quality and a margin of safety. In addition, if we go right here to stock unlock, you can see that if we go right here to insider tab, you can see that ownership. You can see that 48.63% of this company is owned by the Arnold family. And what do we know, everyone? As you can see right here, we know that founder family-owned companies right here, right? So founder-led companies and family-owned companies do tend to outperform the market over time. And that makes sense because our interests are aligned. In addition, if I show you the insider transactions, you can see that this entity doesn't stop buying, and that is the entity that is run by the chairman, by the family Arnold. And so I like to see that they have been buying shares a lot. So very good to see. In fact, look at this. This goes back to 2022. They keep buying, and they buy even more when there is a slump. They were not buying right here, as you can see, in December in the 11th of 2025. But now with the stocks collapse, they increased the share purchases. I like to see that. Okay, I really like to see that. And the company has a 3.88 score out of 5 on stock and lock. Pretty cool stuff. Everybody, this was a full deep dive. Hopefully, you found a ton of value. Let me know in the comments below if you like this. And yeah, I'm all here for you. So have an amazing rest of your day. Enjoy.